$1 million, $10 million, and a $50 million portfolio. All portfolios that I've personally managed for high net worth and ultra high net worth business owners. And today I'm going to peel back the curtain and show you the do's and the don'ts for portfolios at each of these levels. If we haven't had a chance to meet yet, my name is Luke Turner. I am the co-founder of Moment Private Wealth, where we help entrepreneurs who have outgrown their traditional financial advisors. And if you want to know what it's really like to manage a $50 million portfolio, well, stick around till the end. I'm going to show you. First up is our $1 million portfolio. And again, for each one of these topics, we're going to be talking about the do's and the don'ts. So let's look at this $1 million portfolio. This is typically what we see for business owners at the $1 million level. Roughly 20% of the portfolio is going to be in cash, so $200,000. About 10% of the portfolio is going to be in public market equities. Think about this as the stock market. And then 70% of the portfolio is going to be in their company equity or business ownership. Hard stop right here. This is the number one mistake that I see traditional financial advisors make that don't work exclusively with business owners and entrepreneurs. They don't include the value of your business as part of the portfolio. Your business is going to be one of the highest performing assets, and we need to make sure we're including that from a portfolio structure perspective. First do is make sure that we have a healthy amount of cash sitting on the sidelines. That $200,000, you are going to have the tendency as a $1 million entrepreneur to try to reinvest that into the business, to try to deploy that into other privately held businesses. You're going to be in that network of business owners that people are going to need money, and you're going to want to do it. You're going to be tempted to do it. But I'd encourage you, do not fall into that trap, because that $200,000 is going to mean the world to you when a rainy day happens in your business and you need to deploy cash back into the business. Number two is make sure that $100,000 that you have is in the right retirement accounts. Chances are, as a small business owner, a $1 million entrepreneur, you're going to be in a situation that you have access to special accounts that larger entrepreneurs don't have access to. One of those main accounts is something called a solo 401k, where you could be deferring up to $70,000 plus in taxes every single year into that special account. That's for solopreneurs, called the solo 401k. Make sure that you are opening those right retirement accounts so you can save money on taxes as you continue to build your net worth and build your portfolio to that $10 million level. Now, we've talked about the two do's. Let's talk about the one don't. Increase your lifestyle. This is going to be a temptation for you. You're going to be in a situation that you're going to be making more money than you've ever made before, and you're going to have the tendency to want to buy the new house, buy the new car. Don't do it. For you to get to where you want to go, a $10 million entrepreneur, a $50 million entrepreneur, you need to make sure that you are not reinvesting too heavily into your lifestyle. Because once you build up that lifestyle, it's really hard to peel it back. So that is your one don't and your two do's. Now let's move on to the $10 million portfolio. For the $10 million portfolio, typically what we see is roughly $3 million is invested in taxable investment accounts. So think about this as brokerage accounts, money that you pulled out of your business. $1 million is going to be in our retirement accounts. We've been socking money away into those 401ks, solo 401ks, those specific types of accounts that only you as a business owner can be investing in. And then roughly $6 million is going to be in company equity. And again, the largest asset typically is going to be our company equity until we have that liquidity event. Now, our first do for our taxable brokerage account, that $3 million, is making sure that our $3 million that's invested in our taxable brokerage account is invested tax aware and tax smart. As a business owner, there are certain strategies that are going to be more advantageous to you than any other retail investor or DIY investor. And these are strategies that you can only be accessing through multifamily offices like Moment. One of those strategies is something where we're going to be able to generate a significant amount of capital losses over time. Now, what a capital loss allows you to do is we can bank them. We can put them on your tax return and we can hold them, think about them in storage until we have a capital event, like you selling the business. I've seen this play out where we've been able to save business owners hundreds of thousands of dollars, if not $1 million in tax liability, actual taxes that they saved, all because of tax smart strategies. Now that $3 million, you're going to have the temptation to do hard money loans, private credit, things that are going to generate a high yield from an income perspective, but are going to be very, very tax inefficient. We have to make sure that the right investment strategies are in your taxable brokerage account. The second do is to make sure that any tax inefficient investments we have are going to be in our retirement accounts. Now, when we think about tax inefficient investments, these are going to be things like private credit, potentially hard money loans, hedge funds, things that spit off a large amount of ordinary income or short-term capital gains, which get taxed at ordinary income rates. You need to make sure you understand the implications of this as a business owner. Too many business owners work with generic financial advisors who do not understand the implications of taxes that are specific to business owners and entrepreneurs. So make sure that the investments that you have inside of your retirement accounts are ones that are going to maximize what we call asset location. The assets that are in our retirement accounts, that tax deferred or tax free wrapper, and that are in our taxable account, which we just talked about a minute ago. Now, what is our one don't? Do not over allocate to private equity. You're going to be in a situation that you are feeling high and mighty. You have your $3 million in cash. You're going to have deals that are coming to you that you've never seen before. You are going to have the urge to invest into private equity and privately held businesses. Don't do it now. Why do I say that? Because the reality is we are just now starting to build up some sort of liquidity bucket outside of the business. The last thing we need to do is to be putting money into 7 or 10 year lockups. There's a time and a place to do this, but this is not the time and the place to do it from a portfolio structure perspective. As a $10 million business owner, you still have a long way to go before we start deploying heavy amounts of capital into private equity, venture capital deals that are going to be tying up your money. We've talked about the $10 million portfolio structure. Let's talk about our last portfolio structure, the one you've been waiting for. What does a $50 million portfolio structure look like? Now, for this portfolio structure, what you'll notice is that there's no business ownership listed. Because oftentimes at this level, for the clients that we're working with at the moment, I've seen a liquidity event come into play. And there's $50 million sitting there in a brokerage account, and we need to decide how we're going to be allocating it. And so for this example, what we're going to assume is that 90% of the money, roughly $45 million, is going to be in our taxable brokerage assets. And then roughly 5% or $5 million is going to be in our retirement accounts. Now, we're going to cover this the same way. What are our 2 do's and our 1 don't? Our first do is to make sure that we have enough money in our war chest that we never have to worry about money ever again. You've just had this liquidity event. You've cashed in your chips. You've taken your highest performing asset and you've sold it off. Well, the reality is our income is now gone. And so we are fully relying on this portfolio and these assets to fund our lifestyle forever. So make sure you have enough money in your war chest to withstand any downturn in the market. Typically, we see this somewhere between 5 to 7 years worth of your living expenses. So if you're spending $1 million a year, that would mean that we would have roughly $5 million to $7 million in our war chest. Cannot emphasize this enough. That is our number 1 do. Our number 2 do is to make sure that we are investing tax smart and tax aware. So this liquidity event has just happened. There are certain tax strategies that we're going to want to implement today that are going to be appropriate for this specific calendar year that you sold in that aren't going to be applicable for next year. But those are going to be strategies that we have to make sure that we are being mindful of. The other thing to be thinking about is that when you're at a $50 million portfolio structure, there are going to be certain investments from a tax perspective that are available to you that aren't available to the $1 million investor. They're not available to the $10 million investor. They're only available to folks that have $50 million plus portfolios. And you need to make sure that you are getting access to those types of investments. If you are invested with a financial advisor, you're at a $50 million portfolio level, and you are not having conversations that are different than when you were at the $1 million or the $10 million level, I would highly encourage you to start thinking about those other opportunities that are only available to people at the $50 million level. And then lastly, what is the number 1 don't? The number 1 don't is do not invest too much money into private equity too fast. Now, don't hear what I'm not saying. There needs to be a large amount of your money that's going to be deployed into private equity, venture capital, alternatives that have a high expected rate of return and have a liquidity premium, meaning that you're tying money up, so you should have a higher expected rate of return. But don't do it too fast. As I think about entrepreneurs, what I typically see happen is if they do not have guardrails around it, meaning we have a certain amount of dollars that we want to allocate to these alternatives and we have a time frame that we want to do it, they deploy money too fast. And 2 main problems happen. Number 1 is that they get stuck in one vintage. If you look at venture capital or private equity, the people that got the expected rate of return are typically ones that invested in each vintage. So they might have invested a tranche of money in 2020, 2021, 2022, 2023, 2024, 2025, and different things were happening in the economy at different times there. So some of the returns are going to be a little higher, some are going to be a little lower, but you're going to get that blended return. If you invest all the money in one vintage, say 2025, you are going to be subject to whatever happens in the economy for that specific vintage. It puts you in a position that you are taking on a lot more risk than you're intending to take. And the second thing is that if you deploy all the money, when that home run deal comes and you want to back up the pickup truck and you want to dump a lot more money in than what you typically put in one private deal, you're not going to have the ability to do it, because all your money is already going to be tied up and deployed. So don't deploy money too fast into the private investments. So as we wrap up today, we've talked through the $1 million portfolio, the $10 million portfolio, and the $50 million portfolio structure. We specifically help entrepreneurs and business owners that are at that $10 million and $50 million inflection point. If you're one of those business owners at that $10 million or $50 million level and you feel like you've outgrown your traditional financial advisor, check out the description below. There is a link down there to schedule a meeting with me where I can talk through these specific strategies and see if they're a fit for you. And if you haven't already, if you enjoyed this video, don't forget to comment, like, and subscribe to the channel, because we're putting out more and more content just like this for entrepreneurs and business owners.